Hey everybody, welcome to another video. I am really super bored today. Had a bit of a frustrating day, but everything's all good. And since I was bored, I decided that I'm going to make a video right now, and I'm going to give away some free stuff. Okay, free stuff. So stay tuned, watch this whole video. I haven't planned it out. It's going to be very seat of my pants kind of thing, but I'm in the mood to be generous. Now, why am I in the mood to be generous? Well, I want to kind of start with kind of the state where Forex trading is right now with the internet and the information age. Now, every night you kind of go on YouTube, and I like to see what my competition is doing all the time. And you just do a search Forex, and you'll find this young guy, young guy, young guy, young guy, no experience, no experience. No experience, no experience, no experience, even less experience, young girl. This guy has some experience. Another young guy, another young guy, another young guy, another young guy, all telling you how you're going to get rich. Now, you can do the same thing with stocks, and it just drives me absolutely crazy. Another young guy, no experience, another young guy, no. The fact that these people are young is not the problem. The problem is they don't have any experience. None of them have traded for more than 2 or 3, maybe 4 years at the most. And the market has been fairly consistent because of the Fed during the last 12 years. And these younger traders, maybe they've come up with methods that kind of sort of work, and they've had some success with them, and then they go out and they give all of this stuff away for free, and they don't even really want to charge you anything. They just want to get the eyeballs, like 39,000 views. This girl right here, I don't say nothing against these people, right? 30,000 views, 126,000 views, 69,000 views, right? And they're giving away 99% Forex strategy scalping, right? These guys are hilarious. Now let's look at some actual facts, shall we? Now, bear with me. I'm not just going to rant about young people, because I was young once too. I made a lot of money when I was very young, when I was trading. So I'm not saying it's an age thing at all. I'm saying it's an experience thing. So if all these people are making money and selling stuff on YouTube, let's look at some actual facts, okay? Some actual data here. So what we're going to look at here is something very interesting. Here are 12 million trades. This is real data from FXCM, a Forex broker. And this could be stocks, same thing. Could be Robinhood. I've seen all this data. It's all the same. So you can see here that a lot of the time, traders can win up to 71%. I see on the Aussie dollar pair, retail traders are winning 71% of their trades, 66%, and even in the worst case, they're at 49%. So you can see that it's not hard to place winning trades, right? It's pretty easy to place winning trades. Any clown, nothing against any of these people, not calling them clowns, but they just don't have experience, right? And they are placing these winning trades, and they're out there telling you how the rich family, how you can become rich because they placed a few winning trades over a small sample size, okay? Now, okay, that's the rant part. Now, why, if that is the case, all these traders are placing winning trades, how come 95% of retail traders lose money? Well, it's what they don't tell you. And here's what they don't tell you. They don't tell you when they place winning trades, they average 52 pips or 52 cents. It doesn't matter. This could be pips or this could be stocks. And when they lose 94. Let that sink in. They're all out there showing you all these winning trades that they make, but they don't tell you about those big losses that they take. They hide that from you, and then they go out and they try to sell you a system, and they show you those winning trades without those losses. And even if they have had a short period of time of success, it hasn't spanned across different market environments. Now, again, this is not a bashing video. This is just a reality check for people to understand that it's not how much you win, it's how much you make that matters the most, okay? And so don't pay attention to anybody that's telling you they're a winning trader. Unless they're like me and you can see every single trade that I take in my room, okay? Every trade I take is posted here, time-stamped in my room. Winners, losers, you see them all. And I'm up 193% all over the last 16 months. Now, I did this room for that purpose. I did this room because I know how easy it is for these fake gurus to go out there and start showing you nothing but winning trades. And I understood the scam, if you will, that they're showing you all these winning trades, but what they're doing is they're hiding how much they lose when they lose. Now, these are actual statistics and facts, okay, guys? Okay, so that being said, there's the end of that rant. Now, what am I going to do? Why did I do this video? I promised you guys I was going to give you something free, and just if you've stuck around this long, congratulations. So, in my room today, I talked about using a grid system, because Forex is a really hard market to trade, and you have to be really, it can be very random. And I want to share with you guys some more facts and more statistics and more reality, okay? You're not going to hear me showing you pictures of myself, you know, and my tattoos and my vacation and my rented car for the week and my $500 model that I bought as my girlfriend. You're not going to get that stuff for me, okay? You're just going to get numbers, statistics, and actually walking my talk, okay? So let's look at some real numbers here, okay? And once we look at these numbers, then we're going to get into me giving you a system on how to exploit these numbers. Okay, so what you're looking at here is a 1 year's worth of data, on this case on the Dow 30. And what you're seeing is from the open to the close, the number of times the Dow went from 0 to -4, basically from -4 to -6, -6 to -1, -1 to -2, and as high as -2%. So on this side of the spectrum is the number of times that the Dow basically had a big measured move, and on this down, and this one had a measured or trending move up. So you can see over a year there were really only in this case 14 days, 3 days, 10 days. So 14, 10, and 3, about 30 days out of the year where the Dow trended in one direction. That makes sense to you guys? And the same would be true on the downside, approximately. A little bit more on the downside over the course of a year. But you can see the vast majority of time the market stayed in between a range of negative from 0 to about 1%. And here's a 3-month period, and you can see that it's a little slightly different, but the vast majority of time the market does not move more than 1%. Okay, now why is that significant? Okay, now what I'm going to do right now is we're going to look at a few other points of data here. Here's the S&P, same thing, right? This is the S&P 500. And you can see the vast majority of time the market barely moves 1%. Here's the NASDAQ over 3 months. And you can see, again, the vast majority of time the market barely moves 1%. So what does that mean to your trading? Right? What does that actually mean? Well, let's just say that this was the open of the market. Okay? And this is 1%. And this is negative 1%. Okay? What that means is the vast majority of time, the market is doing something like that. Or something like that. Okay, the vast majority of time, the market is completely random. That's right. Intraday, if you are trying to day trade intraday, the market is random over 85% of the time. This is statistical proof of this, okay, guys? You can't argue this. Okay, now we're going to get to how we can exploit this. Now let's take a look at something else other than the stocks. Let's look at the Forex market. Okay, so here's the Forex market. This is the GBP US dollar. Look at this. Doesn't this freak you the hell out? Like, that's 90% of the time. From the open to the close, the Forex market on the GBP almost never moves more than 1% up or down. Let that sink in. Okay? Much less volatility versus the stock market, right? In case you thought this was random, here's the euro. And let's look at an even more thinly traded stock. Let's look at the Canadian dollar. All the same, right? Okay, so if the market is so random, then how are all these people on YouTube making so much money? They're not, right? Because they're getting stopped out a lot. Okay, so now I've got that part off of my chest, all right? Because I really want to get rid of this. I want you guys to make my video viral. Because if you can make my video viral and share it and like it, add comments, please say a lot. It's going to help the rest of the people in this world avoid all the scams and nonsense that's out there, okay? All right. So for that gift, for you helping me make my video viral, I'm going to give you a free gift that will not conflict with what I teach my students. Because what I teach my students is I teach my students to avoid that randomness like the plague. Okay? That is my whole trading course is built around how to avoid that randomness of these markets that barely move and how to exploit that 15% opportunity. But as a free gift to you, because I can't give that to you for free because that's what my students paid me for. It's not fair that I do that. I'm going to give you a way that you can exploit that randomness, and keep in mind that it is going to be more difficult. Okay, so here's my free gift to you on how you can exploit randomness. Okay, so first of all, we want to come up with a market that is going to be the least random possible. And we know that the range of randomness in the currency pairs is much less, meaning that it's actually much more, which is what we want. We want more of that back and forth volatility. See this? This is what we want. In randomness, we want that, okay? If you're trying to trade some strategy or some pattern or something, this stuff is what's going to kill you. But if you're trying to exploit randomness, then this stuff is manna from heaven. All right. So what we're going to do is we're going to build a system right now that is a scale-in grid type system that you can start using tomorrow and start making some money. All right. So you've lasted 15 minutes. Well, trust me, it's going to be well worth it. So we know that from the open to the close, that the GBP almost never moves more than, well, let's take a look at that actual data. The GBP here. We know that it almost never moves more than 1%. Like 4, 7, 5, and 2. So 4, 7, almost 13 times it has it moved lower than 1% over the last 12 months. And the opposite is true on the other side. So yes, there are going to be times when this doesn't work very well, and that's okay. We'll give you a way to work with that. But in the meantime, what we want to do is we want to build a kind of a grid, if you will, but we don't want to do a grid the way other numpty fools do grids. We want to be intelligent about it, okay? And the way we're going to do that is we're going to be using volume profiling, okay? And that's what this is right here. If you don't have volume profile, I highly recommend that you get a charting package that allows it. TradingView has it. It is one of its indicators. It's called session volume, okay? And there you have it. So what we're going to do is I'm going to look at, in this case, if I was coming into this day right here, okay, I'm going to scale it out a little bit more just so I can see more time here. Okay, so if I was coming into this day right here, what I would want to do is I would want to measure on the open, we want to measure where is 1%. It's the first thing I would want to do. Okay, so 1% to the top side would be right about there. Okay, so that would be an extreme move on the GBP USD. Okay, so I'm going to mark off 125.94. That would be an extreme move. Okay, now I would also want to just look at these volume profiles here, and I would want to say, okay, is there any level around that might make some significance, right? Now, what we're really looking for is we're looking for areas of clusters of volume and or areas where there is no volume. Okay, so in a case like this, for example, this would be a level that is within that range of 1% that would possibly act as some form of resistance for me. And I want to find a couple of these, okay? As many as I can, probably like three or four. And so I'm going to have to scale out a little bit here, and we're going to use this low here on this day, and we're going to use, that's good enough, right? We also, we'll use this level right in here. See this kind of cluster in here, this high volume cluster, which is kind of like a POC in here. Okay, so now I have 1, 2, 3, 4. I need one more. Yeah, that's okay. I have 1, 2, 3, 4 to the top side. Okay, so I know that the market is probably going to have a hard time moving 1% or more, right? And what I want to do is, if it does move up, and I would do the same thing on the bottom side, okay? So we'll do the exact same thing. We've got a high level POC here. this level right in here. See this cluster of volume in here? Somewhere in the middle, right? Again, we want to go 1% to the downside, right, from the open. There's 1% around there, which put us right around that low. And I'm going to use this level right in here. Again, what am I looking for? I'm looking for areas of what is called low volume nodes, or where there was no volume. Because what that means is that price was rejected. Whenever you see no volume, it means a price was rejected from that area. And can't hold those. The areas where there's high volume, that's areas of liquidity, okay? My students will understand that. So we're looking for 3 levels below the market. And let's see, we use this level right here. See this level right here? I kind of like that. Okay, so now I have it. I've got the market's going to open right here. I'm going to have 1, 2, 3 levels above the market, and that's going to be 1%, kind of a worst case scenario. And then 1, 2, 3, 4 levels below the market, okay? Now the idea is we're going to buy, we're going to short this level, and we're going to scale in at this level, and we're going to scale in at this level. You got that? But this is a scalping strategy. It's not necessarily, it's a day trading scalping strategy, okay? And that's our plan. Now, if it blows through that level, we'll add at this level, and we'll add at this level. And a worst case scenario up here, if these 3 positions lost money, that would be your absolute stop loss, okay? Got that? Okay, same thing below the market. So let's just go. I'm just taking any random day here, guys. I didn't plan this out or anything. I told you this is completely by the seat of my pants. Okay, so let's just go candle by candle here and see what happens here. These are, I'm just going to go down to a 1 minute candle. Oops, sorry. Okay, and yeah. Okay. So here's the start of the day. We're down on a 1 minute candle now. Okay? Remember, we're going to short here. We're going to, if we have to, we're going to short here. If we have to, we're going to short here. But this is a scalping method. If we're going to buy here, we're going to buy here, we're going to buy here, and we're going to just average in. Remember, the idea is a worst case scenario, we have an average cost. Okay, now you could even do it another way. You could do one quarter here, 1 quarter here, 1 quarter here, and 1 quarter here, 1 quarter here, 1 quarter here. You get the idea, okay? So let's just continue with this during the day. And we're gonna play this the whole session, and we're gonna act as if we could trade the whole session just for fun, because I don't know where you are in the world. Okay, let's just go. I have no idea what's going to happen here. Okay, let's just continue here. We did not get triggered in on that trade yet. So there was no trade. There we go. We get our first long right there. Okay. Boom. We make money on that. Now remember, this is a scalping method. The idea is that you do not want to hold these trades for long periods of time. And if a trade goes against you, the point of averaging is to average down and then scale back out to a minimum position. What do you mean by that, Steve? Well, remember, we're trying to take advantage of that randomness during the day. So if we have to add to a position, the idea is to add to the position and then scale back down to our original size when we can. Well, hopefully if as well too. Okay, so boom, this was a winner. So this is a situation where I'm going to just take profits, right? Just going to take profits. And you can see that reaction there. I mean, that gave you 44 pips, right? I mean, that's pretty good, right? Don't you think? Okay, let's continue. Remember, we only have a quarter size on this position though, so nothing really great here. I'm just going to speed it up a little bit faster here. Okay, so that's pretty much the entire Asian session. You got one trade that would have made you some really good money. Okay, let's go into the London session. Boom. So at the start of the London session, you get triggered into a short. Okay. Again, you're just going to get out quickly. You're not looking for home runs here, right? I mean, there you have it. In that particular case, that's 40 pips, right? One short in the London session. Okay, now we got triggered into a long on the London session. Another winner. Okay. We get triggered into a short during the New York session. Okay. Okay, this one's going against us. Back to break even. And that's where we are. Okay. So there you have it. We'd be still sitting in this one losing position here. We didn't even add to our trade and we're in a negative position. Now what would happen at the end of the day? Well, you want to reset at the end of the day. Okay. At the end of the day, you want to reset to the point where you just close it. So in this particular case, if you were allowed to trade that entire day, you would have had 1, 2, 3 winners and 1 loser. Not bad, right? Now, obviously, you can't trade the whole day, but you get the idea. All right, so what we're trying to do is we are trying to exploit randomness. That is the key. And how do you exploit randomness? Well, you don't know because, this is a really nice, easy day. It was fairly rotational, right? But you're not going to always get that. You're going to get days like today, like this day right here. Let me just remove all of this, right? So on a day like this, we would have done the same thing. We would have, drawn all of our levels. This wasn't so rotational, right? This was rather directional, okay? But you still probably would have done okay because you, well, let's do it for fun. Okay, let's do it for fun. We'll take like an average day, then we'll take a directional day. Okay, so on this particular day, again, we would measure 1% from the open. There's 1% right there. Let's measure that off. We know this day is going to go straight up, so we're just going to not do the bottom side. Okay, so there's 1%. And again, we're going to look for levels in here, low volume nodes like right there, that low volume area. See this level? We're going to look for low volume and high volume. Those are the two things that we want to see. So we got a level here. So we got 1, 2. Let's get one more. Probably something right around here. I want them to be like relatively close to each other, right? Like I don't want them too far spaced out. I want them to be, fairly decent distances, equal distances between each other. Okay. So let's now go down to a 1 minute chart and let's go to that day, which was not today, which was yesterday. Okay, we'll go to the start of it here. We have our levels drawn off here, and let's run through it. Let's see what happens. Okay, remember this is a scalping method, right? It's a scalping method. No, when I say scalping, I'm not talking about micro scalping. You've got you got to look at the level, the difference between the two. So, for example, in this particular case, you have a 28 pip difference between the two. So I want to make at least 28 pips. So when I say scalping, hopefully you'll understand what I mean by that. I need to make at least 28 pips because if I don't make 28 pips, I may get stuck in an average position that's going to not work very well. So when I say scalping, I mean more of a shorter term type of thing. You have to measure it between the distances between your scale ins, okay? And we start off in the Asian session. Boom, up we go. There's my 28 pip winner, just like that. Okay, comes back up again. Maybe I try another trade. So let's play the worst case scenario here. We get back in, right? But this time it blows through. We're on 1/4 position size right here. Now, when we get filled up here, what does my average cost become? My average cost becomes that. Got that? I'll make that a different color. We'll make that my average cost on my short. So now what I want to do is when I get filled here, I want to scale out of this position and go back to my original position size. Okay? And I just did. Okay, so I got out. I now have my original position size here. Now the question is, do I add again? Right? That's the question you're going to need to ask yourself. And, you know, I don't think I would, you know, because I'm expecting a real rotational day, right? So unfortunately, I didn't add, but you can see that I would have got out break even, right? If I did add, then I would do the same thing. So if I decided to add again there, I would get out right there on half of my position, and now I'm going to be looking for about 28 pips on this average cost. So that would put me somewhere around there, right? 123. See if I can make some money. But remember, anything below here is profit. Okay. Ooh, look how close that came. Boom, right? Very, very, very close. Anything below here is profit. Right now, in this case, you could move your stop to break even if you wanted to. But boom, you get it. Just like that. Beautiful. Exploiting that randomness. Okay? So now let's continue. Let's get rid of that right there. And now let's see what happens when the market goes against us quite substantially. Okay? So now we're out of that position. Now maybe you add here a 1/4 position again. Okay. You add again. Now your average cost is back in around here. Okay. Goes really against you. You add again, which means your average cost is probably going to be somewhere around there. Okay. Now, unfortunately, you do not get out of that trade, right? You just miss it. Maybe you do, right? Maybe you do. I don't know, but you miss it, right? And now the trade goes all the way up to your worst case scenario, and that's it. You're done for the day. You've got to close that position, okay? So that's a situation where it goes against you. Now, you're going to have a net loss in that situation of 2 units at, you're going to get out at that close there. And that's what your net loss is going to be. Okay, so I did that intentionally because I wanted you to see when it doesn't work. Okay, I wanted to see when it doesn't work. I showed you a case earlier today where you would have had several winners. In a case like this, you'd be losing, right? So nothing is going to be perfect, and I'm glad we saw that situation. Okay, all right. So there you have it. Now, another thing you could also do in this particular case, what I probably would have done is on this ad that I made here, I probably, when it just missed that, I would have probably moved my stop to break even on that ad. So where I really would have lost is I would have lost on that unit and on that unit at the end of the day. Okay? No fun, right? You would have lost, it would have been down, would have been terrible. But I want you guys to see the strengths and weaknesses of using these things, okay? But there's a very bad day. That's a day when the market moves against you completely and closes at an existing difference. But you're not going to have very many of those days. Remember, we know by the statistics that the market is only going to do that like a very small percentage of the time, 15% of the time. So 15% of the time you're going to have a situation where that occurs. Does that make sense, guys? Right? You know, same would have been true like on a day like today where it closes here. You would have actually made money on that particular day, right? Here's another situation where you would have had the market move against you, but I think there would probably be enough retracements in here for you to, for you to do okay. You wouldn't have made a lot of money on that day, but you wouldn't have lost a lot of money. Days like this, you're going to make a fortune. Here's another example where you see these randomness back. That's going to get you out of those trades really easily, okay? This is really what we want to see. The New York session was not that great. But as long as you've got that rotation, like this rotation here, you're going to be fine. Now, I would stop trading this, by the way, probably somewhere around probably 2 o'clock, 2:30ish, right? Stop trading. I wouldn't initiate any new trades around 2 o'clock, 2:30ish. See, even a situation like this where you could think you're getting yourself in big trouble on that trade, well, that big random move back is going to save you. This has enough rotation in it to get you out at, even though that looks like it's going to be a bad day, there's probably enough rotation in that to get you out at a small losing day. It's not giving me the thing anymore. But you get the idea. Okay? So how do you exploit randomness? You exploit randomness by scaling into positions and by scalping them, not looking for those big winners. Okay? Now, if you happen to be one of my order flow students, that trade right there, how easy is that to trade, right? I'm never going to trade that trade to the long side. I'm going to scalp it to the short side. Okay? My order flow students will confirm that. How about that trade? My order flow students. You're going to be going both directions on this trade. Remember, you're going from the close. In a situation like this, I'm going to go both directions. Okay? My order flow students on this particular day, we're going to go both directions. Okay? My order flow students on this day, we're going to go both directions. Now, let me give you one last tip for those of you that have lasted 40 minutes with me. One of the things that you can also do when you're looking at these situations is you can throw up an average true range if you want to. And that will help you gauge the potentiality of the move. So if you really wanted to also throw up an average true range. Just go over here and go average true range. You throw that in. What you're going to need to do in this situation is obviously do it on a higher time frame, right? So you want to know what the daily average true range would be on this, because this will help you. So for example, the average true range is I can never read this right. 263 pips. Yeah. That looks like 206. Is that 263 pips? Does that seem right? That seems right to me. Yeah, that's 263 pips. Right? So the average true range is 263 pips on a daily. And you can use that as a filter as well too. Obviously, when you have a massive average true range, the likelihood of going outside of those 1% or that 2% is much higher, right? So what I would probably do, you could probably even throw an EMA on here, right? But I would just look at these peaks and valleys. So, like if I'm looking at the average true range over the last year, I can see that what was high, 146 was considered high, right? And, 71 was considered low. And so whenever you see something that spikes above or starts getting close to those danger zones, don't trade this, okay? Don't even think about trading this when you start getting outside of your average true ranges, okay? The downside, you don't have to worry about it so much, but the top side, you have to worry. Like this entire time, I probably would have avoided it until we got back down below 150, right? So basically from here to here, during these types of markets, you definitely do not want to be doing what I'm telling you to do, because you will get your ass handed to you on a silver plate, okay? And you just have to just be very aware of the volatility in the market. And you can see this was a very unusual event, right? This was also a big move. This was Brexit, right? This was back when Brexit happened, right? So you get the idea. Okay, so there you go. You guys have it. A great little strategy for you to exploit random market conditions, and stop trying to, get into something and hold on to it forever. Because in randomness, and we've proven beyond a shadow of a doubt, and one more slide I want you to look at. 2 more slides. This is why these guys are winning 71% of their trades. Because they are exploiting that randomness, okay? But the reason why they end up as the 95% statistic is because they don't know, they over-exploit randomness. Does that make sense? And by scaling into your position, you won't be overly exposed. You have to know how much you could possibly lose at the very, very beginning of the day, and you want to scale into positions, because how this number happens is they get into a trade, right? Let's go back to our little trade example here on this particular day, right? So let's pretend that they get into a trade down here. All right, let's say they got short on a trade let's say they short that level right there, right? Just for fun, okay? You'd be buying it, but you get the point, okay? Now what happens with retail traders is they get short on a flag, oh, here's a bear flag. Everybody see that bear flag? Or a break in a retest, right? Whatever these people are selling, I have no idea, but doesn't matter. What happens is, because the market is random, and who knows, maybe they're looking at that and they're saying, oh, there's a downtrend. Does everybody see that downtrend? That's a downtrend. I'm going to get short right there. And what happens is they're overcommitting in randomness. So they overcommit here, not understanding that the market is random 85% of the time. And we could easily fly way back up here, right? I've been watching a lot of Jim Gaffigan. What's that comedian's name? There he is, this guy right here. Jim Gaffigan. And my wife and I have been watching a lot of him at nighttime, so I'm starting to talk like him right now. If you've ever watched him, if you've never watched him, he's freaking hilarious. But gets old real fast. But anyways, so if I sound like him. So what happens is they get into this downtrend and they overcommit, not understanding the randomness, right? And then they say, oh my God, that downtrend is going to still work. And they overcommit and they add again to their trade. And before they know it, that randomness spanks them out, right? By overcommitting. And now they close their account and they've blown their account for the day. It was a downtrend though. And then it changed. Well, if they would have looked at the goddamn math on the day, they would have known that this range is nothing, right? I mean, it could have very easily done that, right? It was barely down anything at all on the day, right? We could have very easily done that. The math proved that to us beyond a shadow of a doubt, okay? And the chances of you catching a trend intraday and it actually working are next to zero, right? And that's what I teach, by the way. If you like what you've heard so far and you want to learn, but how can I catch those trend days that are 15% where the market really makes big moves? That's what I teach. And that is where the greatest edges are. Because in this randomness, you're still sort of just guessing, right? You got to guess at what levels are going to be significant and what levels are not. But if you can trade those 15% of the time when the market is non-random, and that's what I teach. So if you've liked what you've heard here, give it a try, put it into work, see if it works for you. It will work. It will make you money if you do it right. If you follow the right money management, you will make money. But if you really want to learn how to exploit non-random conditions, then you really want to head on over to my website and buy my course. Okay? Bye for now, and love you all.